Well, taxes can sound quite complex. Deductions, ATC, ATD, income tax filing, your return date, and there are so many terminologies, right? Sometimes it can get complex, but we promised you we'll answer all your queries related to income tax filing. And remember, this time around, the due date is 15th of September. So there's still some time to go. So what are some of your questions you wrote to us? So thank you for that. We'll be answering all of them on the live today. And to answer that, we have with us Divya Jokhakar, who is the partner at B.D.Jokhakar Company, which is a firm for chartered accountants. She's been a practicing chartered accountant for a long time, and she's here and promised us to make it all simple for us. So let's get it started. Thank you, Divya, for joining us.
Thank you for having me.
You know, it's a lot of times that we have these questions. What are the top things that we need to keep in mind when we are close to filing our income tax return? And when we are closer also, there is a lot of stress. So make it simpler, the top 5 things or top 6 things you think everyone should keep on their radar when it comes to filing their return.
Sure. The number one thing that you must keep in mind is updating your bank statements, keeping all your bank statements updated for 31st March 2025, since we're talking about the financial year 24-25, downloading your 26AS, AIS and TIS form, also having the broker's ledgers and capital gain reports if you've invested into equity shares and mutual funds. Another important thing is you must have your pre-validated bank accounts on your CPC income tax portal. So in case you have a refund, it will directly get credited there. And very importantly, if you sold any house property, you must keep purchase agreements and sale agreements, and possibly a fair market value report in case if you need any. But these are the basic documents that you must have. And in case you're a business professional income earner, you must have financials or maybe books of accounts written by your chartered accountant, so it becomes easier for you to compute your income well.
All right. So, you know, usually chartered accountants would guide you where these documents are available. Just to make it simpler for you, 26AS, your AIS will all be available on your income tax filing website as well. When she said CPC income tax portal, it's the website where you have your username, your password, you can log in, and you will get a list of your 26AS, AIS, and these are documents which will have a sense of all the tax which is deducted during the financial year. In this case, it's FY25, that is for 26AS. And annual information statement will have all the details of the transactions,
True.
Be it the dividends that have come in, be it the interest that has come in. So these are some documents which will help you understand, okay, this is where maybe I'm liable to pay some taxes, right? So that's the most basic thing. These are some things that you need to keep with yourself when you are planning to file your income tax return as well. Divya, the other thing that we want to understand is, you know, when we are filing the return and we realize, oh, this is the regime where I'm planning to, or I have to pay more taxes. Right. Can you change your regime, tax regime, when you're filing your taxes, filing your income tax return?
Sure. So what happens is, let's break this into 2 parts. One is those salaried individuals who are not earning any kind of business or income. You have the option of swapping from the old regime to the new regime YOY. So what happens in the beginning of 1st April 2024, your employer would have asked you if there is a specific regime you would like to opt out or opt in for. And now let's say you did not mention anything in your Form 12BB, which is your salary declaration. They would automatically deduct your TDS under the old new regime presently. While filing the ITR, let's say you have other income from dividend, capital gain, which you have not declared to your employer, you can swap out. So presently there is a default regime called the new regime. You can do a swap in, swap out any point in time YOY. Provided you're a business professional person filing the tax return, you only have once in a lifetime opportunity to get out of the new regime and go to the old regime. Once you are in the old regime, and only if your business stops to kind of make profits for you or you cease to exist in your business, only then you can kind of swap in and out YOY. Otherwise, there's only once in a lifetime opportunity for you to go from new to old and back and stay there forever. Okay. So that's the difference that you'll have to manage while you're filing your ITRs.
For individuals, they can do it every year?
For individuals and HUF who are not into business profession, anytime possible during the year, any part of the every year. But if you're into business profession and let's say you want to opt out from the new regime, you'll have to file a specific form called 10IEA. You'll have to upload it on the return. It's basically a punch-in form, and put that acknowledgement number in your return of income. So the return processing happens with the old regime.
Okay.
Yes,
Okay.
so
So you can
taxes
do it
get
while
considered.
filing the return as
That's
well.
right, immediately.
All right.
That's right.
Makes sense. So businesses only once, but individuals with salaries or HUF, they can do it every time they're filing the return. So that takes us to the point, well, what are the different types of forms that one should be aware of? Is it different for different incomes, or is it different for the different type of status that you have, maybe individuals, maybe HUF or companies?
So charity trust have to necessarily file ITR 7. If you are a corporate, there's downright ITR 6 for you. If you are a firm or an LLP, it is ITR 5, including if you are association of person, body of individual, let's say a Willingdon Gymkhana or any kind of a clubhouse, which is AOP BOI, will have to file ITR 5, including the LLPs and partnership firms. Now, let's say you are an individual, you have span of ITRs from ITR 1, 2, 3, 4.
Got it.
If you are filing your business professional income under presumptive taxation, then you will have to necessarily file ITR 4. In case you have any other special incomes like cryptos, capital gains, you will have to go to ITR 3 regardless of the fact whether you are showing books of accounts, showing no books of accounts, you are earning business profession, and also that you are not filing or filing with presumptive taxation. So presumptive taxation is one kind of a taxation where you can only file ITR 4, not ITR 3 as such. But if you have any other income, you go to ITR 3. Let us talk about those individuals who are earning salaries, no business profits. You have two options to file ITR 1 Sahaj. If your total income is below 50 lakhs, you do not have any foreign assets and income.
Got it.
Otherwise, you go to ITR 2 automatically. The difference between ITR 1 and 2 is also very specific for the say that if you have more than one house property, you will have to necessarily go to ITR 2. So ITR 1, you need to remember only 4 quick things. Your total income has to be less than 50 lakh rupees. You do not have any other income which is business or profession specifically. You can have your salaries, house properties, income from other sources. You should not have foreign assets and foreign income, and you are only a resident individual or HUF.
Understood. Oh,
Yes.
that makes it very clear. So
Yes.
I'm sure a lot of our viewers are individuals as well, so this really helps them. You briefly mentioned capital gains. I'll come back to you on that in just a bit. But I just wanted to quickly apprise the viewers as well of the difference between new tax regime and old tax regime. In new tax regime, we do not have deductions available, and in old tax regime, we do have deductions available under ATC, ATD, and the other sections as well. So let's come to old tax regime. If somebody thinks that old tax regime would mean that it will lead to lower taxes, what are some of the deductions which are available, and when, according to you, should somebody do an old tax regime? Of course, it's individual as per the income that you have, but some of the broader points, when should one look at that?
So it's very fair and simple for one to compute your taxes in both the regimes simultaneously before you file your ITR. Now, once you are computing under the old regime, you claim all the deductions, not claim, I'd say, I compute it in. So you have your total income, which is same in your old regime and new regime. From the total taxable income, you should reduce your PPF investment, ELSS scheme, LIC insurance up to 1,50,000 rupees. If there is a contribution to a national pension scheme by your employer, it is additional 50,000, so it becomes 1.5 lakh to 2 lakh rupees. Then you go to ATD, which is your health insurance premium. That is additional 25,000 to 50,000 depending on the cases. A specific 10,000 is to non-senior citizen for saving interest, and 50,000 to senior citizens under ATTTA or TTB. And very importantly, if you made any donations to a charity organization, you must take ATG donation. Once you have both the computations ready, you must gauge at what is a beneficial kind of a tax and then go file your return.
All right. So there must be calculators available as well online, right?
Very easily available on the income tax website. You just have to do a www.incometaxefilingindia.gov. On the left side, you will see the tax calculators. You just have to put in your taxable numbers and it will just come out easily.
Okay, so that's an advice coming from a CA that you can go ahead and do that work yourself as well before actually going to a professional filing. It gives you an idea of what kind of taxes you will be paying,
True.
right? Always good to be aware about your liabilities as well. So in that case, Divya, there are some people who have to pay taxes.
Sure.
But there are times when you don't have to pay tax, but you have an income with you. Do you still think everyone should file a tax irrespective of the taxability that they have in their hands?
So let me explain what is the amount not chargeable to tax. If you are an individual in HUF, you have two regimes, old and new. Let us presume that you are a person who is usually filing in the old regime. you must see if you're a senior citizen or not. So if you're not a senior citizen, your slab limit starts at 2.5 lakh. Senior citizen is 60 plus, so it's 3 lakhs, and beyond 80 is 5 lakh. If you're filing under tax regime, it's age agnostic, and therefore your slab starts at 3 lakh for all the ages. Now, once you've evaluated that your total taxable income is not crossing the slab limit, it is technically used as maximum amount not chargeable to tax. Then you need not file your ITR for individual and HUF. Corporates, partnership firm, LLP, all of them have to file a mandatory ITR, including a charity trust earning some kind of donation income. Now let's go back to individual and HUF. If you have not crossed the slab limits, there are other provisions which make it mandatory for you to file your ITR. Let's say you have a TDS deduction, so you want to claim a refund, you will have to file the ITR. You want to claim carry forward losses of capital losses from your equity share sales, mutual fund sale, business losses, you will have to file the ITR to take it forward in the next years. Thereafter, you may also want to kind of file the ITR if you have paid more than 1 lakh rupees to a credit card agency, you have donated, you have made an investment into your bank account of more than 1 lakh rupees, and foreign travel of 2 lakh, electricity of 1 lakh, current account deposit of 10 lakh. So there are a lot of criteria which may take you into filing the ITR, and 100% you must file an ITR if you have any foreign assets and income, despite the fact you are not liable for taxation.
Oh, that is such an important list, right? Thank you so much for telling us that, because sometimes the idea is even if we have assets and no income, why do we really need to file taxes? So that's an important clarification that is coming by as well. Okay, so we have spoken about what is the difference between new tax regime, old tax regime, what are the types of income tax returns as well. But let's talk about capital gains now, right? It's huge. We have a lot of our viewers who are traders. There are people who invest for long term, maybe short term. How do you go about that when it comes to capital gains, particularly for an individual?
So let's first talk about shares, mutual funds, which are financial assets, and then we take up the immobile properties in the next question. When you are investing into equity shares or mutual funds, you must get your capital gain report and a broker's global report all the time. If you are investing on your own, obviously those websites through which you are investing, you will get a download of all the workings. Most probably you will always have a capital gain computed therein. The slab rates are as such. If it's equity oriented share, mutual fund or equity share, the taxation will depend on the period of holding. Right? So if it is a listed equity share, the minimum holding period is 12 months. More than 12 months, it goes for long term. If it is a short term, it is taxable at 15%. If it is a long term, from 23rd July, the tax rate is 12.5%. And before that, it was a 10%. You get a flat exemption of 1,25,000 from the long term equity shares held, which is computed under tax rate of 112A. So there's a specific section called 112A, which one can look up and try to understand that how the July slab rate will work for the taxes. Then we go to the mutual funds. So there are equity oriented funds which are listed again, which will work like the equity shares. We talk about the debt oriented mutual fund. When you talk about the debt oriented mutual fund, if it's a short term and less than 24 months, it is at the slab rate. And if it is more than 24 months, then you will also have to say that it's a long term and will be taxed at 20%.
So here it's 24 months
yeah, it's more than 24 months. But if it's after 12th July, again the tax rate, 24th July, it will be at 12.5%. Okay. So any date of sale for either the immobile properties, which we will explain a little later, and also equity shares and mutual fund, it is 12.5%. But the questions will arise usually before that, and it can get a little complex.
It can, and you know, what we'll try to do is, we have discussed it in greater detail, because with debt funds also, what is the proportion of the debt? Is it more than 65%, less than 65%? Then you have fund of funds, there's gold ETF. So there have been a lot of changes that happened last year as well. But if you can simplify that for us, a lot happened with real estate as well, because the indexation was removed. Can you explain what indexation is in simpler terms? How did it impact the calculations generally?
Yes. So let's take a date of sale of your property before the 23rd of July. Now, if you had sold a property before 23rd of July, the tax rate was a flat at 20% with indexation. After the 23rd of July, you had two options. You take indexation at 20% tax rate, or without indexation, it is 12.5%. Let's say the property was purchased way before 1st April 2001. You can substitute the fair market value for the purchase cost. If it was after 1st April 2001, you need not have a fair market value report. You can go as per the actual purchase deed and do your indexation. So it becomes very easy for the taxpayer to understand based on the date of sale.
Got it.
Also, there will be a TDS of 1% if you are a resident individual, or if you are an NR, your TDS rate would be higher, maybe to an extent of 24%, that the purchaser would have deducted. It will appear in your Form 26AS, it will appear in your Form AIS, and therefore that much tax credit will be set off against your final liability, if any. If there is no liability and you were loss, you carry forward the capital loss, and the TDS which is deducted will come as a refund in your ITR.
Okay, interesting. And by the way, I'm actually reading out all your queries as well, and that's why I've been looking at the phone as well. So we have received a lot of them. We'll discuss that during the course of this discussion as well. If somebody has multiple sources of income, how do you bifurcate that in an ITR?
Yes.
Say somebody also has capital gains, has salary income, has income from other sources, and also has house property income. One income tax return would suffice all of them? How does it function?
Yes. So you must prepare a bank summary. If you have most sources of income applicable, so there are 5 heads of income: salary, house property, business profession, income from other sources, and capital gains. You must technically prepare a bank summary. What is the meaning of bank summary? Bank summary means that you total up all your credits according to the sources of income, whatever has been received in your different bank accounts, and then consolidate all the bank account income according to the heads. So let's say I have an ICICI bank account and a Kotak bank account. I will put all the credits into the respective heads of income and then total them bank-wise, and then compare on base of the TDS reconciliation. Now, what is a TDS reconciliation? Is that whatever amount that you've got in the bank is actually a net of TDS. So let's say the dividend is 10,000 rupees. They would have deducted around 1,000 rupees, and I would have got 9,000 in my bank. Therefore, I must compare that 9,000 of Procter & Gamble is matching with my bank statement. And therefore, the taxable income would be the gross amount before TDS, which is 10,000. And therefore, the TDS reconciliation will give you the gross incomes where TDS has been resulted. You have to compare it what's in your bank. What is the difference would be some amounts possibly on which TDS is not deducted. And therefore, you will possibly have to take higher or deep dive into the fact that how to compute your taxes based on the reconciliations.
So, it's interesting you mentioned dividend, because that's exactly a query that I just received, and they talk about what should we do with dividend income? How do we calculate taxes? Is it something that's shown in our AIS already that we should continue with, or are there any different provisions of taxing your dividend income? There had been a change in the taxation there, so explain that to us.
Sure. So dividend was liable for TDS if it was more than 5,000 rupees in a financial year. Now there would be some kind of dividends which have hit your bank account and there is gross dividend less than 5,000 rupees. Therefore there would be no TDS and it would not reflect on your Form 26AS. Now what is Form 26AS is a pool of all the income on which TDS has been deducted, but the various deductors were paying you the income. If I have a dividend, again, say Procter & Gamble of 10,000, it will appear in my Form 26AS. But if I have received only 2,000 from, say, Tata Motors, it will not come on my Form 26AS. And therefore, the summarization of the dividends hit to my bank account is a must. How do you disclose in the ITR is a general question. So there is a field of income from other sources and there's a little tab called dividends. So you have to put all the taxable dividend there before TDS. So gross values of dividend. And if you're filing the ITR on your own, there is one document which opens up and fetches the information from the AIS and 26AS on its own on the income tax portal. But you need to be mindful that if you are putting the dividend through the Form 26AS and you also reconcile, there's one total amount that goes into the dividend bracket, but you need to break it up into the quarters so that your advance tax, which is underpaid, is managed before you file your ITRs in your self-assessment tax.
All right. Also, right now it's as per slab rates, right? The taxation on dividends. Earlier, the companies used to deduct dividend distribution tax. That was changed. Now it's in the hands of the shareholder. So even if they have deducted taxes, say on the 10,000 they've deducted a tax of 10%, maybe as per your slab rate, if it is exceeding that 10 lakh rupees, you might have to pay 30% taxes. Am I correct? So yes, always make sure that you know, you reconcile, as Divya just mentioned, your bank statements, AIS, 26AS. That's the most basic thing, and that's when you'll realize how much taxes do you have to pay. Just briefly, because a lot of people get confused, because most of them are salaried employees as well. So the question of advance taxes doesn't come so much, right? But they do have other income. They do have house property income. So how does the advance tax mechanism work?
So let's hit the question this way, that advance tax is not applicable to any senior citizen not having any income from business profession, and also advance tax is not applicable in case you are only a senior citizen. So what happens usually is, in case you have business profession income and you are a senior citizen, which is 60 plus, there is no advance tax. So it's fine if you pay all the taxes together in one shot. I'm just earning dividend income, capital gains, that's fine. For those who are on salary, usually might be below 60 years of age, because that's a pre-retirement age, you should compute your advance taxes. The benefit under advance tax is, one, that you do not have to pay taxes for advance computations as long as your total estimated tax is not more than 10,000 in the financial year. So as a date, I'll have to project, for example, for the next year to see how much is the tax liability in my projected computation. Second point is that if you have sold capital gain in this quarter, I have the benefit of going one step forward and paying the advance tax by the ensuing quarter. So I'm saved on interest on lack of advance tax. So what one must do is that you must do an estimation of your incomes, come to a tax figure, subtract your TDS which you had estimated maybe on last year's basis or current year 26AS, inflated a little, and see what is the tax liability towards the year end. If your future house property sale, you must factor that as well. My recommendation, go to CA, get your workings done, and possibly take an opinion or consultation if it's a huge amount.
So just come back on capital gains. So suppose I have sold a share in the quarter April to June, and it's a short-term gain that I have. So do I have to pay taxes immediately in that quarter, or can I pay advance taxes? Does it have to be in the same fiscal, or if we file it during filing an ITR, is there an interest and penalty? Because a lot of people, while filing an ITR, realize, oh, this is my capital gain statement, I might have to pay interest on that.
Correct. So you must, if you are in the first quarter, you must pay your advance taxes by the 15th of September, specifically for capital gain, because you have a leeway not to pay by 15th of June, which is the first quarter. Provided you are a non-resident, the TDS would have been already deducted on the sale value. And therefore, there is a very strong chance you might be in a refund position. And therefore, there is no advance tax liable therein. So you must take a global report or your broker's contract ledger and work it out so that every quarter you are aware of the fact that by the next quarter, what is the amount of advance tax that I must pay.
But capital gains, is there TDS deduction on capital gains? I don't think.
But on the non-residents, there will be a TDS deduction because you are a non-resident liable to tax in India because it's a deemed income. But on residents, there would not be any TDS for the capital gains.
And that's why they have to be aware of filing it with an advance taxes.
That's
so yes, you do not have to wait till your ITR due date comes when you have capital gains, especially short-term capital gains, because that's where there is no limit, so to say, right? So you should be paying it within the financial year itself so as to avoid any interest or penalty. So that's a very important point, because a lot of our viewers actually deal with shares and have liability in terms of taxes as well. You mentioned NRIs. So is there any specific form for NRIs? How do they go about filing their income tax returns?
So NRIs who are not earning any business profession income in India, they do not file ITR 1 at all. And if they're not earning any income from business and profession, they have to go to ITR 2, else they go to ITR 3. Presumptive taxation is not applicable for NRIs. So there is a business trader or a professional, they're not applicable as such to presumptive taxation. So they will have to see which ITR applies from 2 and 3 specifically. They must ensure that they are aware of the taxes well in advance, because most of it will appear in Form 26AS and TIS AIS. So possibly with a click of a button, they are able to kind of file their ITR, which may be a little simpler thing unless they've sold a property in India.
Got it. When you say presumptive taxation, if you can make that easier for our viewers as well.
Sure. So let's break this into again two parts, because presumptive taxation is a tax regime for those business professional people who have gross receipts up to certain threshold. There are two kinds of people who are earning income from that kind of a source. One is business, one is professional. Now, who are the professionals? Doctors, lawyers, interior decorators, chartered accountants. They are specific professionals who can apply for 44 ADA section, where up to around 50 lakh of rupees, you can offer taxation or taxable income from that profession of 50% of that value. But in case your gross receipt reaches up to 75 lakhs in the financial year 24-25, you must ask yourself a question whether any kind of gross receipts, whether it is up to 5% of the total gross receipts in cash. So let us say, for example, I have earned 60 lakh rupees, which is more than 50 lakh rupees. Have I got any cash receipts, cash income from my billing up to 5% of the gross receipts of 60 lakh? If the answer is yes, then you may not be able to go for presumptive taxation. But if it is not applicable, then up to 75 lakh presumptive taxation is allowed. So you offer 50% of 60 lakh, which is 30 lakh rupees, without showing any books of accounts in your ITR. We go to the business people. Business, you cannot offer presumptive taxation by the LLPs, so partnership firms, individuals. You can offer presumptive taxation up to extent of 6% of your gross receipt when your threshold is up to 2 crore rupees. And you've earned all your gross receipts in bank. Just in case some portion is received in cash, then you will have to offer at 8% of the gross receipts. So 44 AD is this one section which allows eligible business people to file income under presumptive taxation for those who are only earning business, and 44 ADA is for those people who are under professionals. There's one more section which is not for the corporates as specific, because there's another presumptive taxation for shipping and airlines as well. But for individual, you must also see, if you're a transport business, you must see section 44 AE. Based on the number of lorries and the trucks that you hold, up to 10 lorries, there is a specific 7,500 rupees per lorry for the month that in which you're using that. So that becomes presumptive. So presumptive is basically a taxable income rate that is given attached to your threshold of the gross receipts that you earn. If you fall under that bracket, you have to file ITR 4.
You know, you took me back to my CA final days. I'm just remembering all the tax books that I've read, and this is what it reminds me of. So that's great. So this is what presumptive taxation is. It is not for individuals or salaried professions. It's for people who are maybe into a profession or have a business to run as well.
Not for salaries.
Not for salaries. So this is where presumptive taxation comes in. So see, I have taken my AIS 26AS, then I have my bank statements, I aligned all of them, I punched in my numbers when it comes to capital gains, which is a different rate altogether. Then I have my salary, then I have my house property, I compute my taxes and I file it. What are the next steps? What are the important steps that ensures that yes, it is submitted properly and I have an acknowledgement from the income tax department?
So while you're uploading the ITR on the income tax portal, there'll be 4 options that will pop up. Whether do you want to e-verify the return in 3 ways. One is using the digital signature, which usually the business people would have. If you are a director in a corporate, you would have that. If you are a partner in a partnership firm or LLP director or a partner, which is a limited liability partnerships or partner, you will have a digital signature handy. Second option is you can e-verify using the OTP attached to your Aadhaar. The third is you can do an EVC, which is called the electronic verification code, which is linked to a bank account. So the bank will send you an OTP on your email/mobile number attached. One recommendation is that you should have single mobile number attached to your Aadhaar and the bank account, so it becomes easier. If you have none of these options being helpful to, you just download the ITR-V, sign in blue ink and send it to the Income Tax Bangalore or CPC address. Therefore, you will get a receipt from them, and that ITR-V will become an acknowledgement. You should do this within 30 days of filing your ITR. So it becomes a validated ITR. If you forget to do a verification, then the ITR will become defective. It is equal to not filing your ITR. So you must immediately do that.
Okay, so you can file your ITR, but if it's not validated, it is not equivalent to filing your ITR. So that's a very important takeaway. I filed it, I got it validated as well. Wow. But I realized I made a mistake. Now what?
Okay, so presently you have a due date of 31st December 2025, up till which you can revise your ITR. So all that mistakes that you've done inside your ITR can be corrected suo motu on your own, and you can change whatever you want inside. keep backup papers and file it by the 31st of December 2025. Ensure that the acknowledgement number of the original ITR is mentioned in your return, which is going as revision.
Okay. So you have time, folks, first to file your return, but ensure you don't make any mistakes. But what if I actually miss the 31st December date as well? What happens then?
Also that if you miss the 15th September deadline, you have a penalty of 5,000 rupees, despite the fact you might be revising your return or filing the ITR belatedly and not filing it in the original due date. Now, when does the penalty of 5,000 strike? Is when your total taxable income is more than 5 lakh. If it is less than rupees 5 lakh, then the penalty is 1,000. So, first is, do I need to file the ITR by 15 September if I'm not liable for tax audits, or if I'm a partner in a partnership firm liable for tax audit, or if I'm a person who is into the other brackets of the other due dates. So if you miss that, you have a due date of 31st December, and if you are filing it by 31st December, you must ensure that the penalties, interest thereof is filed up along with any kind of liabilities that arise therefrom.
Got it. And if I don't file it till 31st December also, then
it's just gone.
It's gone.
Yeah, the time is gone. You've lapsed and you failed.
You fail, and then there'll be, this is the taxation, this is the penalty. You will get notice.
You will get a notice, and you will have to reply, and there will be an opportunity for you to be given that whether you can file it under this little section called 148, because it will be called as reassessment proceedings, and it is just sent by the income tax officer. There's also a slight chance that you will get something first from the CPC income tax, that look here, you have not filed your ITR.
What's CPC?
Yeah, so CPC is the Centralized Processing Center, which is by the Finance Department, Finance Ministry of India, and they have a little portal called Income Tax E-Filing.
Got it.
And that's where you find all these jazz happening.
Yes. It's jazz, I'm sure it's jazz. So, what are the different notices one can receive? For an individual, let me talk about that, and a sole proprietorship or HUF. Let's not get to bigger corporates or anything.
Yes.
But because when you get it, do you really need to panic? Like, is it something of a panic situation, every notice?
So within 7 days of your ITR, right now the government is so fast and quick that you immediately get a refund or you get an intimation. Now, intimation is supposed to come to you by 31st March 2026.
Got it.
Apparently, because you still have the end of that assessment year, and we are filing the ITR for AY 25-26.
Correct.
Now, the first thing that will hit you is 143.1. It is called a deemed computation by the income tax website. It is an intimation. If you do not get an intimation, your acknowledgement of the ITR is your deemed intimation, and you need not panic about it. If you've already got the refund, you will automatically get an intimation in your system, and an email will come from the income tax portal. If you have mismanaged your ITR, there is a problem, you may get a notice under defective return.
Got it.
And you will have to correct it under that specific section and file the ITR afresh. If you do not respond to the defective notice, then the original ITR will become invalid.
Okay.
So it is as good as not filing, and you will have to hit the belated due date, which is 31st December. So you must ensure that you are well prepared the moment March is over. So April, May, June is by the time all your 26 AS gets updated, and just file the return by June or July.
Okay, so there has been a follow-up query that has come to me as well. We were talking about the type of ITRs. What is the case for gig workers or freelancers? What kind of ITR do we get there?
So freelancers are usually not the people under salary. When I'm doing freelancing for say a corporate or another entity, my TDS would be deducted under 194J unless I have a contract with them. As long as I have a contract with them, there is a possibility that they would be hiring me on contract basis, and they would be deducting TDS under 194C, which is a TDS related to contract. Either which ways, you will have to find out whether you are actually a profession under the professions that I named. Are you a business consultant? Are you a technical consultant? Or are you any other from these? If that's the way, then you also have a chance of filing under presumptive taxation. And if not, if you cross the threshold maintained in the Income Tax Act, you will have to maintain books of accounts and then file your ITR.
So the ITR would be?
So the ITR would be 3, and if you're presumptive taxation, ITR 4. There is no chance you can go to ITR 2 because it's ideally business or profession.
Got it. So that clarifies. When is audit compulsory? Who does that audit notice come for?
Alright. So tax audit applies to those business houses or individuals who have a flat gross receipt of more than 10 CR in the business. If you're a professional, then the limit is more than 75 lakh rupees in the financial year. So I'm talking about all gross billings. No deductions, no
So there have been
expenses
no
claimed.
deductions. So if you receive 60 lakh, she's talking about that 60 lakh amount. There's no deduction.
Yeah,
in
so
terms
we'll
of
keep it
TDS.
75
Yeah.
lakhs.
Okay,
Yeah, 75 lakhs.
All right.
Right? So 75 lakhs is for professional. Let's call a doctor earning 80 lakhs. Mandatory application for tax audit. If you are a business house or a business individual or trader, then any gross receipt more than 10 CR is applicable to tax audit. Now the ITR applicable for that tax audit is actually 31st October, but by the 30th of September you'll have to upload your tax audit report signed by a chartered accountant and your good self.
All right.
Yes.
Okay, so take that point. But the crux of the matter, to make it, of course, she's made it as simple as we can, is to ensure that you have a bank statement prepared. You go to the income tax website and look at your AIS, which is annual information statement, your 26 AS, which will have details of all your tax deducted at source. And in case of salaried individuals, of course, your HR or the human resource manager will send you Form 16 by the end of the financial year as well. And all the tax planning that you have to do has to be done before 31st March. You can't be making ATC investments while filing your income tax return, because that will mean you have to ask for it in the next assessment year. Assessment year is the year when you are assessing your taxes for the previous year, that is the financial year. So basically FY25 is the year for which you're filing taxes. FY26 becomes the assessment year. So these are just some basics that I thought we should talk about again. And now I will talk about your individual queries, because we have received a lot of them. We spoke about how to show dividend income, that you discussed in greater detail as well. But there's one on how can one claim DTAA benefits. Let's first understand what DTAA is and how can anybody claim benefits around that.
Right, so DTAA means it's a double tax avoidance agreement. It is specifically applicable for Indian tax resident individual who have foreign income. What is the definition of foreign income is very important here, is that if you have invested outside India into say equity shares, mutual funds, or possibly into houses, and you have any income coming from those sources which are not applicable to India as a land, then that becomes foreign income, and therefore the foreign country possibly will have the right to tax that income even there, and it's called a foreign tax credit that you may want to avail in India. Now DTAA is a tax avoidance agreement which helps the resident of a particular country to combat the double taxation on the same income. So if I am earning income from Facebook Inc., which is the dividend in foreign USA, and I'm showing the return of income, then whatever is the foreign tax credit in USA, I will be able to get an offset of that against my Indian taxes up to a certain extent, whatever is mentioned in the treaty. So they're complex to read and understand, but you must kind of have a working, you should have a TIN, which is the tax identification number of the foreign country. You should always keep a challan or a working that they have provided from abroad.
All right. There's a specific one on how to show dividend income in ITR 3. Is it the same thing that we discussed
It's the same
earlier?
thing. It's the same thing.
All right. Okay, so there's one where they are talking about company erroneously allocated less HRA or calculated the wrong taxation or deduction on house rent allowance. How do you go about changing that or ensuring that the correct one goes in your ITR?
So if you want to speak to your HR first, get that sorted. That's number one, because that's more practical. If you are missing the deadline, you may want to file the ITR based on the current Form 16 compared with 26 AS and possibly revise the return later when you get a revised Form 16. There is a strong chance that if the company has made an error, they'll have to revise the TDS return, and therefore you will get a revised Form 16. So you will have to possibly get in touch with the company and get the revision done. If you don't have time, just file the ITR the way it is and then revise it once you get the revised documents from them.
All right, so you will get your benefit. There's nothing to worry about.
Yes.
Just need to speak to your HR or do whatever Divya just advised in terms of getting the correct deduction. Somebody's income is below 7 lakh, but they've made short-term capital gains. Will tax be applicable in this case?
Right. So this is under the new regime that 7 lakh is the rebate available. Unfortunately, there is no leeway. You will have to pay tax on the short term unless it is based on the slab rate. So what I mean is, if you've sold listed equity shares and they are short term applicable, then you will have to pay necessary 15% tax plus the required education cess thereon, and there is no leeway. But if they are debt oriented mutual funds or any other short term, it will get subsumed in your slab rate, and you can possibly benefit that in your slab of 7 lakh rupees in the rebate portal.
Okay, so to make it simpler, in case there is no slab rate as such for capital gains tax, there are different rates altogether.
Yes.
That's correct. The 7 lakh one is largely your slab rate. So if you have any other income under that, you can take that benefit. But for capital gains tax, you cannot take it so
If
much.
I may just correct this, it is only for short term that is not
Yes,
allowed, but long term will be subsumed in the rebate.
Long term will be
Yes,
subsumed in the
yes.
rebate. For short term capital gains, it will not
That's
be. And
right.
the person who has written to us has made short term capital gains, so he will
Yes.
have to pay taxes on this one.
That's right.
How should merchant navy officers go about taxes, because they sail 4 to 7 months of the year? What to do here?
So if you're more than 6 months, that is 182 days, then, and in case you are like aboard on the ship or a vessel, then automatically a non-resident. You should inform your bankers that you have an NRO or NRE account. Any income credited to the NRO NRE is exempt, because few years back there was a CBDT circular saying that the income will be not taxable in India because you are ideally outside the country. If you are less than 182 days in India, unfortunately you will be considered as a resident Indian.
All right. Okay, so that I hope that explains your query as well. You know that conversion that happened from Tata Motors to Tata Motors DVR, how to treat the deemed dividend due to that conversion? How do you go about whatever the applicable taxes because of that conversion that came up?
Sure. So Tata Dividend has done 3 things. When the conversion happened, there is a sale that has happened on the old DVR, and therefore there is a capital gain, either short term or long term, depending on how much you held for. So it's 12 months or more. Then they also issue deemed dividend in your bank account, and on which TDS was deducted, which will ideally reflect in your Form 26 AS and AIS. If the amount of deemed dividend was more than 5,000 rupees, if it's less, it would have hit your bank account. To pay the TDS, Tata took a little portion, a fraction of your shares, and that will become your short term. So I'll make it a little more simpler. Is there are 3 parts to it. The first conversion, on which your sale consideration was 1,111 rupees. For the conversion, that sale consideration is applicable to long term or short term. Let us presume I have held more than 12 months, so it is a long term capital gain. The deemed dividend will be income from other sources against which the TDS has already been deducted. I'll get a credit for it. And the little portion that has hit your bank account also, because of fraction shares, are short term. Because the moment you were to get that little share, it is sold pertaining to the TDS that they wanted to pay. So it's like a cash hit. And therefore, there are 3 elements that will be there. How do you find out what are the details therein? You can take your DPID number, go to the Tata Motors website and punch it there under maybe the investors module, and there will be something which will come up what is specifically pertaining to that PAN account, and your registered email ID definitely has got a document from Tata.
Okay, so that will help. Please check in your emails as well.
Yes.
Just confirming again on the short-term rates, because there was a change from 23rd July 2024, which will be applicable in FY25 returns as well, right? So before 23rd July, for only listed equity shares is what I'm talking about right now, long-term capital gains has increased from 10% to 12.5%, and for short-term capital gains, it has increased from 15 to 20%. Am I correct there?
Yes, 15 to 20.
So when does the slab rate kick in? It is for non-financial assets, for short-term capital gains.
For short-term capital gains on listed equity shares.
So when is the slab rate for short-term capital gains?
23rd April, the short-term, the slab rate is when they are debt-oriented mutual funds.
Got it.
Ideally. Or any other asset which are not listed.
Not listed, not listed funds. So yes, that is very
That's
important.
when slab rate hits you.
Correct. So I just wanted to clarify that because it gets lost in the translation as well.
No worries.
And we have the last query. Does one have to declare foreign currency purchase of approximately 1.4 lakhs anywhere? It is there in the annual information statement, but what happens with the ITR?
The reason it is there in the AIS because tax collected at source has happened, because the financial institution from where you picked up your currency has collected your TCS. It is actually like your TDS, for which you might want to claim the credit. If you are a person who has cross total 1 CR of gross total income, you will have to fill this schedule called Schedule AL, which is at cost. So there is a little tab called cash. You will have to show the INR value of that foreign currency there. If you are a person who is maintaining books of accounts or not maintaining books of accounts because you are a business professional person, then you will have to show it in your balance sheet. And if you are not showing the balance sheet, then you will have to declare it in the ITR on a tab called cash on hand under no account case. So you will have to figure out that whether you are only applicable to filing Schedule AL in your ITR, or are you filling balance sheet or no balance sheet, depending on the case, as I mentioned.
All right, that explains it very comprehensively. So just a few takeaways before we wrap on this very educative live. Thank you so much, Divya, for
Thank you
joining
for
us,
having
by
me.
the way. But yes, important documents that you have to keep handy. As I said earlier, annual information statement. You should know, by the way, the username and password of your own account. Usually the CAs have it, but it's best to keep that handy for yourself as well. Get your TDS statement, that's 26 years, get your Form 16 in place. Ensure that you're aware of whatever incomes that you have generated in a financial year. It could be taxable, it could be non-taxable, but it's important to keep a track of all that. So bank statements, they come in handy. And if there's any confusion, there's no harm in going to a professional. Go to chartered accountants, ask them how you can go about, filing your income tax returns. Ensure that you validate them. If you do not validate, it is as good as not filing a return. And if you have any defects in your income tax return, for which the due date is 15 September, you can file a revised return till 31st December 2025. So these are some of the basics. Of course, most specific answers are given by Divya as well. But thank you so much for tuning in today for this live, and keep writing to us. So if you have any queries related to taxation and you want us to talk more about specific ideas or sections of taxation, and we'll get them answered, or we'll try to ensure that your queries are clarified as well. Thank you so much for tuning in, and thank you, Divya.
Thank you.